We have Aishvarya Dadheech of Ambit PMS, who is talking to us today. Aishwarya, afternoon. You look at that broader market space very closely. First, let's talk about the valuation of that pocket. After the correction, October onwards, the correction happened. And actually, if you ask me, the conflict in Russia only accelerated that correction, which was on since October. And small cap, mid cap, both the worst brunt. Some of them 40-50%, even more, got hit. After that, do you see there is a case for a relook in that area?
Thank you, Ajay. Good afternoon. See what happened in the last 5-6 months in mid and small cap in the broader market. Basically, take away all the froth which had built in all those last 2 years, right? And we believe on valuation side, mid caps and the small caps, especially say the mid cap index, is now trading almost in line with large cap, right? So that there's an opportunity which is existing into the whole space. Second, and the most important point is definitely mid cap have outperformed Nifty 50 in say FY22. But if you look at the data slightly older, if you see the last 5-year data, right, the broader market, the mid cap and small cap are still underperforming. I think in the last 5 years, the underperformance is as acute as 16-17%. So there's a lot of catch-up game that will happen in the broader market. And more important is we understand that there is a very strong correlation between how the economy does and how the broader markets. There is a very positive correlation. So once we see this economy coming out of this, the unlock theme playing out going ahead, mid cap and small cap will do meaningfully well. And Ajay, we all know that, a lot of these sectors, especially on the unlock theme, where we should say, especially about say QSR or, restaurants, hotel, airlines, luggage, most of those names are available in the mid-cap category itself. And we should not forget that, when you highlighted about Russia, Ukraine, and in the last couple of quarters, the maximum impact on profits was visible in the broader market. So the earning growth will still be the higher in mid and small cap, the broader market compared to large cap over the next 2 years. So we believe any investor should have now a very decent allocation, given the valuation comfort, giving the higher earning propensity. They should be able to make good returns out of it over the next 2 to 3 years in this category.
Right. Aishwarya, talk to us about how last 6-8 months, due to this correction, which are the areas and kind of businesses which you have been studying or topping up your positions for that matter, where you see secular argument on the business growth being intact and robust?
So see, we are very, positive on the economic recovery perspective from India at least, right? So we believe this unlock theme, should do really well going ahead, and sectors which will benefit because of the economic recovery should be the focus point of investors in that particular regard, right? So we are very, very positive about say BFSI as one sector, right? We believe if you see the last 2 years, right, the theme which actually played out was deleveraging. Majority of these companies, the cement companies, the metal companies were deleveraging. Now we are entering into a point where re-leveraging will start. And I can tell you that the balance sheets of the banks are at such a good level, which we haven't witnessed in the last decade or so. Like most of these banks are over-provisioned as of now. They have a very, very strong, capital adequacy. And if you see the last quarter, which went by, the majority of profits was supported by banks. And I think this will happen over the next couple of quarters. So we believe private banks, good NBFCs are the play, one should look at. Apart from that, if you really look at what happened with Russia, Ukraine, we believe the whole narrative of the geopolitical has changed, right? Over the last 20-30 years, the theme which actually played out was globalization, the interdependence. But what happened after Russia-Ukraine crisis, a lot of these countries were left, not been able to get those key things which is required for the economic to move ahead. So we believe deglobalization can possibly a theme which could play out for the next couple of years. So a lot of this manufacturing units, especially in pharma space, chemical, textile, paper, we believe that a lot of this, manufacturing plus capex theme can play out for various of this country, and India will not be an exception. And apart from that, we believe this, which I was talking to you about, sector which will benefit from the opening of the economy, like what said, cinemas, like we say airlines or say luggage, so these are the area, even say QSR for that matter. these are expected to do really well over the next year or two. So we have got into names like this. We increased our allocation to BFSI over the last 1 year or so, and we remain pretty confident about the same.
What have you been buying? If you could share some category of names in BFSI apart from banks.
Yeah, so in BFSI, obviously we like private banks the most, like we initially said that, but we believe a lot of, what we say that opportunity still is ripe in NBFC space, especially in the housing side. Now, if you look at housing, growth has not been that high. The housing growth is longing around 5, 6, 7% kind of a thing. But we believe, that the situation is good. So whenever there is a very strong equity market, we believe that is played out in a very strong real estate market. We are seeing a lot of this data of a lot of these real estate players. The kind of pre-launches growth which we are witnessing is unprecedented, right? So we believe NBFC, especially more related to housing, should do well. Auto, which has been a dark horse, CV related things can also pick up well. So we are buying more of NBFC in housing and NBFC which are doing more into CV side, also auto side. So that are the areas which we are looking at, and possibly, it might be a bit too early to tell, but even mid-sized bank could be looked at this point of time, because so it's basically a waterfall which happens. So when the credit growth will pick up, when it will move from say 8% to 9-10%, majority of the gains will happen to the large banks. But when the valuations will start inching up, then investors will rotate and start looking slightly down the curve and look out for other mid-sized banks. So today could be a good time, to look into mid-sized banks, where if you have the 2 to 3 year visibility, this should do well in our assessment.
Aishwarya, I was just looking at your portfolio. You have a fair degree of weight on the chemical space. I mean, we were just looking at the data that even chemical names have done phenomenally well in the last 2 weeks. They've come back, names like Sharda, etc. Where have you been raising your weight as far as chemical goes? And do you see margin pressure related worries ebbing out there? Or can they persist or get more prolonged even from here next couple of quarters?
So Ajay, now chemical have become a difficult sector. Now we were early, investor into the chemical sector way back in 2016-17, when valuation used to be traded around 13, 14 or 15 times forward PE. Now those valuations are as high as 30 to 40 times, right? And on top of it, we have this inflation fear, because a lot of this commodity, the raw material inflation has been around 10% to 30%, which will to an extent visible onto the margins of many of these chemical companies. So overall, we remain very selective in the chemical space. So we are, though, holding decent amount of chemical as an exposure, but the key thing which we look out for is whether these companies has a very strong pricing power, whether they can able to maintain margin. There could be like 1 or 2 quarter of blip, but overall for the next 2 to 3 years, if margin is something that they can really improve, and the valuations is comfortable in conjunction with the growth, right? So even if a company is at 30 times price to earning, right? But if it is going at 30, 35, 40 times, we are okay with that. So there will be a very handful of companies like this, So you can't just completely go and blanketly spray money on chemical sectors. You have to be very, very selective. And we believe that there are still stories, which, because we are very positive on one strategy, which because of the China issue, and even I was talking to you about that deglobalization can really help India to become big thing in the chemical. So long term we are very positive. In short term could be a blip, and one have to be very careful about what they are owning in the chemical space.
Aishwarya, would you look at offbeat open up trades beyond the hotels and exhibition companies? The footwear range, the luggage range, all of that, or even paper companies which cater to office-related stationery or paper, or school-going kids and all of that. Are you open for that? Is that something which interests you?
Yeah, we are very positive on footwear SSP, right? We have a couple of names in our portfolio, right, which we believe it's just not only about open up economic trade, but they are like businesses which are doing phenomenally well, right? Similarly, we like sectors like textile and even paper also, right? But there are very few names which actually clears our very stringent filter, right? So I would say that investors should be, open up in owning sectors like this, right? So textile could be the next big thing, like chemical played out. Similarly, we are seeing a huge traction in paper industry, right? So that will also be the next big play. But one thing I want to, point out to investors, that you have to stay with the best. So you have to stay with the players who have been able to show their pricing power and have the ability to maintain the turf when things are going to be tough because of inflation. But we definitely like these sectors, apart from luggage and exhibitions and all that. Even I'm really excited about consumer discretionary, I must say. So it's the retail part. We believe that that theme would also play out very strong. So obviously, consumer staples are under pressure because of the rural slowdown as well as the inflationary impact. But consumer discretionary is something which will do really well going ahead. So a lot of these, retail businesses which are into say merchandising or possibly clothing and fashion can also do meaningfully well over the next year or two. That should be looked after.
All right, Aishwarya, we'll let you go on that one. Thanks so much for joining
Thank
us
you, Ajay.
on the show today.